Hi guys, good morning. Lucas Rogers speaking from the Rogers Property Group. Just thought we'd put out a quick video this morning to let everybody know and keep them updated on what's happening with interest rates. As most of you are probably aware, that interest rates dropped by another 0.25% yesterday. So the cash rate is now 0.25%, and it's the lowest it's ever been in history. What's going to happen from here? Well, I don't think that interest rates are going to go down any further. The RBA has already said that they won't go down to zero interest rates. So I think we're about as low as we're going to get in that department. And I think really, from an economical point of view, I think the RBA is really at the end of its capacity to do what it can to stimulate the economy from interest rates only. I think it needs to look for, as I've said in previous videos, I think it needs to look for other ways to stimulate the economy, and that might include some industrial reform, some tax breaks for small businesses, which they're trying to implement at the moment, and so on. And I think that's really the only way that they're going to stimulate the economy. So because of this coronavirus outbreak and the panic and the hysteria that goes along with that, they have dropped interest rates just to try and prop the economy up and keep things going. Now, we can look at that in two different ways. I mean, some people, are hoarding baked beans and toilet paper, and they're looking at it from a very pessimistic point of view. But you can also look at this situation from an optimistic point of view as well. Interest rates are lowest that they've been in history. You can borrow at under 3% at the moment, which is amazing. If you're borrowing at under 3% and you've got an investment that's giving you a 5% yield, plus you're getting tax deductions as well, well, that's an incredibly good thing that's not only paying for itself, it's also giving you capital growth as well. And you can do this in major capital cities at the moment. I'm not talking regional markets. So from an investor's point of view, if you have debt at the moment, it's a great time because of the fact that the debt is costing you less to service. If you're looking at getting into the market and your job perspective is pretty safe, then it's certainly a great time to get in. It's a very opportune time to be looking at investing at the moment. I think both in shares and property as well. I mean, the share market's taken a huge dip at the moment, but that will eventually go up, as it always does. And I think from a property perspective, well, property hasn't really dipped, but I think that the cost of ownership is quite low at the moment. Well, it's incredibly low. Because your yield is definitely paying for the interest rate of your investment. So look, great time to get in. Me myself personally, I'm just expanding my portfolio at the moment. Looking at property all the time, seeing what deals are out there and so on. If you want to get on board this market, look for some great opportunities, then look, please give the office a call. We'd love to have a chat with you. Drop me a line, send me an email, and look guys, happy investing. Take care. See you soon.